Markets have weathered a lot this year. Elevated geopolitical risk, a shock to oil supply and prices, and shifts in sentiment in the artificial intelligence space. As we look to the second half of the year, our base case is constructive, but the path has narrowed. We expect continued economic and market expansion led by the United States and supported by AI-driven investment, even without the same degree of monetary policy support that we and consensus expected at the start of the year. Let's break that view down into 3 pillars. First, we expect U.S. exceptionalism to remain intact. This is the case even with oil-importing economies seeing disproportionate, but we believe tactical, benefits from normalizing oil flows in the wake of the U.S.-Iran peace deal. The U.S. continues to have the strongest combination of economic growth, energy independence, policy flexibility, and exposure to AI-related investment. Now, that doesn't mean that every U.S. asset will outperform every non-U.S. asset, but we continue to expect the U.S. to lead developed markets overall over a several-quarter period. One way we look at this dynamic is through the U.S. share of global equity market capitalization, or equity value. The U.S. comprises over 60% of world market cap, and increasingly, this share has become a proxy for U.S. dominance within AI investment, particularly now that a greater share of the full AI supply chain is entering the public sphere via IPO activity this year. Which takes us to our second pillar, which is our expectation that AI remains the market's most powerful growth engine when it comes to both macro-level investment and keeping financial conditions loose. The AI investment cycle is still leading corporate earnings growth, driving capital spending, and supporting market performance. But we believe the next phase of the AI story requires more conviction than the last. Leadership of the tech trade has shifted decidedly towards semiconductors, a segment within tech that over the last decade has shown more cyclicality and more volatility than the Magnificent Seven. This shift in leadership coincides with a new wave of IPO activity, adding companies that are less profitable than the hyperscalers that have led markets over the past 3 years. Now, market tests around convictions stemming from volatility and varying profitability don't weaken our AI conviction. It simply means that quality matters more than ever. We continue to favor companies with durable earnings and the infrastructure supporting AI, from digital infrastructure to materials. Now, our third pillar driving our outlook is inflation and its impact on monetary policy stances globally. While the Iran conflict has eased, inflation expectations remain high enough to influence central bank decision-making. When it comes to the Federal Reserve in particular, consensus expects 1 to 2 rate hikes by the end of the year. We take a different view. We believe the Fed will remain on hold. We don't see rate hikes as an ideal way to cope with supply-led energy inflation, and the labor market has not been tightening in a way that supports rate hikes. The unemployment rate is stable and wage growth is slowing. But with the Fed on hold, the global monetary stance is less supportive than we anticipated to start the year. As long as rates do not create a tightening in financial conditions, we see this environment as consistent with ongoing moderate expansion. So where does that leave portfolios? The opportunity set remains attractive, but the path forward is narrower, making conviction and quality increasingly important. We favor U.S. equities with neutral allocations to ex-U.S. developed markets. We encourage a neutral rather than overweight allocation to U.S. large-cap growth equities in line with our artificial intelligence views. We favor new capital deployments in long-term spending themes, such as digital infrastructure, energy, and defense. We also see opportunities to consider satellite exposures to high-quality sectors such as financials, where fundamentals are robust, but investor enthusiasm has lagged. Across equities, we expect to see a quality premium grow across size, geography, and style. Now, on the rate side of things, we're wary of a bear steepener effect in long rates as fiscal risks remain. So in credit, we prefer a focus on buy and hold opportunities at short maturities. We're also more comfortable adding duration in asset classes with steeper yield curves, including municipal bonds. Now, beyond traditional stock bond allocations, we see commodities as an accretive diversifier, especially given that stock bond correlations may continue to be tighter in a higher inflation environment. For more on this and our other global markets views, you can visit our website at nylum.com/global-markets.